Thanks for joining us today. I'm joined by David Hobart, Managing Director of the Blue Sky Apeiron Global Macro Fund. We'd like to take this opportunity to dig a bit deeper in the thoughts that David has at present and how they're impacting on your portfolios. And David, for some time now you've had a view that global deleveraging will impact on equity markets and thus portfolios. This hasn't delivered results to you recently though. What are your thoughts on why, and has it caused you to change your view?
In terms of global deleveraging, we're always looking for market opportunities where the long-term fundamentals are out of whack with current pricing. And we haven't seen material earnings growth in the last year or two, despite the US equity market, for example, rallying materially over that time frame. So we've seen multiple expansion but no real earnings growth. And we expect that to continue over the next year or so, particularly as the government pulls their head in a little bit in regards to their fiscal deficit spending in America and in other Western economies. So our view is that equity markets are rich where they are. Our view is that the bull market, effectively driven by a 35-year credit bubble, actually ended in 2007 and 2008. And what we've seen in the last 3 or 4 years has been a corrective rally inside of that, not dissimilar to what equity markets saw in 1973-74, for example, where the Dow Jones was in a broad sideways market for 16 years. Well, we think we're in a similar type of market dynamic today. So from a risk-reward perspective, we see value here playing equity markets from the short side, and we think being long equity markets at current levels is highly speculative and not supported by consistent earnings growth. So we'll be playing equity markets from the short side over the coming months.
On the flip side, you've made really good money from your Japanese theme in the last year or so. Do you think that theme's done now, or is there more to play out there?
In Japan, I think we've seen the first phase of maybe a 3 or 5 stage process unfold in Japan. They've got clearly an unsustainable fiscal situation. They've got a debt pile that's larger than any other economy in the world as a percentage of GDP by a comfortable margin. Now at the moment that's not affecting the market. The market's actually just seeing through new policies implemented by the government that the weakness of the yen and a strong 2% inflation target by the central bank, additional quantitative easing, increase in the monetary base, all those policies are actually positive for animal spirits in Japan, and we're seeing that reflected in equity markets. And I actually expect that has got some way to run. The Japanese are now starting to feel confident in themselves, starting to come out and spend. You're seeing some of the terms, particularly in the exporters, are starting to make money again. However, I don't think that's the biggest game that'll play out in Japan. I do think that over the next year or so we'll get continued positive momentum in Japanese equity markets and weakness in the yen, which we'll continue to participate in. But ultimately there'll be a moment of reckoning in regards to their fiscal situation where the central bank is unlikely to be able to hold yields stable when you've got rising inflation. Rising inflation naturally will mean that interest rates will rise, and then all of a sudden the Japanese government is confronted with an issue in regards to serviceability, simply because at current yields the Japanese government's spending 25% of its revenue on interest repayments. So if yields went from 75 basis points at the 10-year to 150, then half of the Japanese government revenue is being spent on interest, which is clearly not a sustainable proposition. So we do think that it's early stages in Japan, and over the next 3 to 5 years there's going to be plenty of opportunity to play equity markets, the yen and the bond market, and find plenty of opportunity.
David, we've seen some fairly aggressive sell-off in fixed interest markets of late. Are you seeing any themes develop on the back of this?
So in recent months we've seen talk of tapering by the Fed, and the market looking at that idea that the Fed can't continue its quantitative easing policies as currently stated ad infinitum. That talk of tapering has caused yields to back up in a lot of the Western sovereign markets, but also the agency debt markets, the municipal bond markets, and the mortgage-backed markets in America. So that's feeding through into corporate credit, and it's starting to feed through into other risk assets like equities. Now, this initial move in rates, one could argue, is purely as a consequence of tapering. Our view is that it's probably a little bit more than that, in that we have a sovereign risk contagion idea in our portfolios where we expect over the next 3 to 5 years the issues we've seen in Europe, starting with Greece and Ireland and Portugal, Spain and Italy. We believe they started in Europe simply because of the currency, the inflexibility embedded in the currency, where individual countries or governments were unable to print their own currency to support their own bond markets. But if you look at Europe in aggregate, its aggregate level of debt is actually less or lower than, as a percentage of GDP, it's lower than the UK or certainly Japan, and is close to that of the US. So you could argue that some of these other major Western economies are actually in no better shape in terms of sovereign or government balance sheets. So we do expect that this is the start of a move. We expect heightened volatility here because we're close to a turn, but we think over the next 3 to 5 years, the value to be made out of fixed income markets, broadly speaking, is going to be from the short side, i.e. we expect yields to rise, and our fund is positioned to capture that.
David, you traditionally focus on global themes. Are you seeing anything develop in the Australian context?
We have a couple of developing themes domestically. One is from the long side, so we're looking at Australian gold miners and the precious metals complex. It's been sold off aggressively by the investment-driven market effectively over the last 2 or 3 months, and gold miners are the obvious candidate for a value play in the Australian marketplace, so they've been punished. But our view on commodities, broadly speaking, is that commodities tend to revert over time to their marginal cost of production. So it depends on the gold miner that we're looking at, but gold mining, with the gold price down towards $1,200 an ounce, it's pretty close to the marginal cost of production for some of these reasonable mid-sized Aussie mining companies. So anywhere between sort of 1,000 and 1,200 we tend to think is going to be reasonable buying for the precious metals complex broadly, and consequently some Aussie gold miners. Our view in terms of where we think gold is going, personally I think gold is perhaps the most irrational asset class in the world. I think it's actually the only asset that people, if they were on a sinking ship and they had a bag full of it, they'd prefer to hold on to it than let go. In other words, they'd prefer to hang on to their gold and drown. I think it's that irrational. But nonetheless, it's been a currency for 5,000 years, and people, when in times of heightened monetary instability, people tend to revert back to what they see as an age-old way of retaining the value of the purchasing power, and gold's a good reflection of that. So I think over the next 3 to 5 years, again, it wouldn't be a surprise to me to see gold go from current values up materially, and gold miners in Australia is probably not a bad way to play that.
And what about your thoughts on Australian banks?
Well, I think in terms of Australian banks, the market's piled into Australian banks as yields have fallen through RBA cash rate cuts over the last 12 months or so. So there was a lot of money piling, held in term deposits, and when the term deposit rate fell below 5%, it went searching for yield, and Aussie banks and high-yielding stocks in Australia were obvious candidates. The question for us in terms of banks, simply from a valuation perspective, if you look at the top 20 global banks by market capitalisation, Australia has 4 of them, and yet we account for 2% of global GDP. There's a mismatch here in terms of how big our banking system is on a market cap basis relative to the rest of the world. Now, admittedly, we haven't had a banking crisis, and I don't expect one, but certainly as fixed income markets start to question ongoing low interest rates, as we're seeing through our global risk contagion thematic, and as bond markets start to sell off, interest rates start to come up naturally in the marketplace, we'd be very surprised if the Australian banks retain their current valuations. So we have in our execution process an opportunity to capture any volatility that we find coming to market in those Australian banks from the short side. So we will be capturing any sell-off we see in bank prices from current levels.
Well, thanks for that, David. It's been pretty enlightening, and I think some food for thought as people put their portfolios together. If people want any more information on your fund, probably the best way to do it is to talk to their advisor, visit the website, or give us a call directly. We'll see you next time.